Hello, everyone. Logan Hertz here with Hazeltine LLC. I just ran a couple of scenarios here and I was absolutely shocked by the results. So, I want to talk about rate of return, which is a very misunderstood metric. And this will just be a very short, simple exercise comparing investing in the S&P 500 to paying premiums into a whole life insurance policy. I'll say this several times throughout the presentation, but whole life insurance is not an investment. So this is not an either or scenario. You can do both. You can have whole life insurance, you can have investments. Both are fine. Both have pros and cons, and both have different goals associated with them. That's the most important thing. One of the reasons why rate of return is not too relevant of a metric, because your goal in the long run is never to achieve a certain rate of return. Your goal is to maybe achieve financial independence or guaranteed income or whatever. But this little exercise, the results shocked me. And when I share them with you, where we are comparing a scenario where we invest money in S&P 500 versus putting money into a whole life insurance policy. And everyone will tell you you'll get a better rate of return in the market than in whole life insurance. I don't necessarily dispute that, but we have to understand, first of all, different goals. Whole life insurance accomplishes what it's supposed to accomplish. With investments, what they're really saying is hypothetically, you might get a higher rate of return in the market. It's not guaranteed. And then when we look at rate of return, we have to equalize because the rate of return that's advertised on paper in the market is a gross rate of return. We have to net out several things. And in order to make it an apples to apples comparison, we have to account for the extra benefits that whole life insurance gives us, like permanent death benefit protection, that the market does not. So there's no way to do a truly apples to apples comparison between the two. And what's important is not necessarily the rate of return, but does the financial tool accomplish what it set out to accomplish? So, with that long winded segue, let's get into the exercise. Now, the results I was not prepared for, they shocked me. Let's start with a simple example of investing in the market. We have $25,000 available to us to invest every year over the next 30 years. We're dealing with a 35-year-old healthy male. He wants to invest his money over the next 30 years and hopefully retire at age 65. And he's going to invest this amount into the S&P 500, hoping for a nice rate of return. From the total rate of return, we've got to subtract a few things. First of all, there's typically a management fee, so we're going to assume a 1% management fee. And then there's taxes, of course. We're going to assume a 25% tax rate. Whatever the S&P 500 makes in that year, we got to subtract 1% for the management fee and then 25% for taxation. We also have to account for the cost of term. In whole life insurance, we have death benefit protection. Presumably, you're going to want life insurance. And if you're not going to buy whole life insurance, then you have to buy term life insurance. We're going to pay $2,000 a year to pay for a 30-year, $3 million term life insurance policy. And we're doing a 30-year term life insurance policy because that's the cheapest. We're doing this scenario over a 30-year time frame. Obviously, the cheapest would be to buy the longest dated term today while we're still young and healthy. We can get the best rate. That means on net, we have a little under $23,000 to invest in the market each year because we got to account for the cost of term. There are many other things we need to account for, but we're not for the purposes of this exercise. I hope to do a more comprehensive exercise where we try to account for all these things. But let's keep in mind, with whole life insurance, we have long-term care protection. So that death benefit in whole life insurance can be used in the case of a chronic or terminal illness, which is a huge benefit in retirement. As you age, there's more risk of you having some negative health events. Whole life insurance provides protection against that. And if we have term, we don't get that after the term expires. There's nothing there. So we could make an adjustment to say we need to buy long-term care insurance. If we're going to equalize the two, then we have to subtract something out of that 25,000 to pay for a long-term care insurance policy. Same thing with liability insurance. Whole life insurance is creditor protected, both the cash value and the death benefit. In order to equalize, we'd have to buy some sort of liability protection policy for our investment scenario. We'd have to make an adjustment for risk. We're going to assume certain rates of return, but we have to adjust for risk and volatility. We'll talk about in another scenario the risk adjusted rate of return, the volatility adjusted rate of return. If I got a 10% rate of return and I'm comparing that to a guaranteed rate of return in whole life insurance, that's not a fair comparison. I have to discount that 10% because I'm taking on risk and I'm taking on volatility. What is the risk adjusted rate of return? There's a whole art and science around how you calculate that. I'm not accounting for any of these additional benefits that we get in whole life insurance that we don't get in the investment account. I am just noting them here. I'm really only accounting for the management fee, taxation, and the cost of term life insurance. And let's see where we end up. Let's look at how our market-based investments play out. We're going to invest in the S&P 500, a little under $23,000 a year because we've got to account for paying for a term life insurance policy and see how it works out. The orange here are our contributions over 30 years, and the blue is how the market investments perform over 30 years from 1994 to 2023, and I'm using the actual returns that S&P 500 gave us over that 30-year time frame. Over that 30-year time frame, we contribute a total of $689,000 to our investment account. And we end up with $1.4 million in our account after investing for 30 years. And that's accounting for management fees, taxes, and paying premiums into a term life insurance policy. There are crashes where the blue bar dips below the orange bar and you cannot see it. So we have the 2000 tech wreck. About 6 years in, we have a crash. Then we have the 2008 financial crisis. 8 years later, another big crash in the market, and it takes multiple years to recover from that. Then in 2020, we have the COVID crash, another market crash that we have to recover from. This is how the market goes. Typically, once every 7 to 10 years, we see some sort of crash in the market. And obviously, if we're invested in the market, while we can get exposure to the upside and get some nice returns, we also have risk to the downside. After taxes, fees, and the cost of term life insurance, our net rate of return over 30 years is 4.4%, right? Not the 8% or the 12% that you see oftentimes advertised. That is an average rate of return, not a real rate of return. And that is a gross rate of return. That's the top line number. That's not what you actually get. You've got to subtract out taxes and fees. And the real rate of return is different from the average rate of return. That's another conversation. What it nets out to is when you're putting your money in the market, the downside crashes hurt you more than the upside gains help you. It takes longer to recover from the downside. This is why the average rate of return that's advertised can oftentimes be higher than the net actual real rate of return that you get. After accounting for taxes, fees, and the cost of term life insurance, your net rate of return over 30 years is 4.4%. And as I say that, we're not even necessarily accounting for the cost of term life insurance in the rate of return. The rate of return is calculated based on what you actually contribute, but you're able to contribute less because you have to pay for term life insurance. So instead of contributing 25,000 a year, it's a little under 23,000. So again, all investments carry risk. Let's look at an alternate scenario using whole life insurance. Just to reiterate, whole life insurance is not an investment. This is never going to be a truly apples to apples comparison. And it's not an either or scenario. I don't want to set up false dichotomies. It's not you buy whole life insurance or you invest your money. No, you can do both. Most people who own whole life insurance do indeed do both. Same thing with term life insurance versus whole life insurance. It's not a versus, it could be both. You can have term life insurance and whole life insurance. They can accomplish different things depending on what your objectives are. I want to avoid setting up a false dichotomy. This comparison is just for instructive purposes. I'm not suggesting that it's an either or scenario. I'm certainly not suggesting that whole life insurance is an investment. Whole life insurance typically has a different goal than investing, which is why for whole life insurance, and I would say in general, rate of return is not the best metric to measure how well it performs. In either case, even with investments, it's not rate of return. It's did your investment accomplish what you wanted it to accomplish? And that's typically not measured by rate of return. But this is an instructive scenario to help you to understand better what rate of return actually means. Because when we're talking about investments, what's advertised is a gross rate of return, which is almost never what you actually get. Whereas when we're looking at whole life insurance, The numbers you're looking at are what you actually get. You're looking at numbers that are net of all taxes and fees. What you see is what you get, and you have access to it on a guaranteed basis anytime you want. Whereas money and investments, the statement number that you see is not what you'll actually get when you try and withdraw money. You're going to have to account for taxes and fees. You're also going to have to account for volatility in the markets. If you have to withdraw money when the market is down, that hurts you a lot more than if you withdraw money when the market is up. That's the sequence of returns risk. That's a conversation for another day. But in this scenario, we're paying $25,000 in annual premiums for 29 years. That actually handicaps the whole life insurance policy a little bit because we're paying in for one less year than we are into the market-based investments. There's some reasons for that. But now what we're going to see is, again, whole life insurance provides all these other benefits that I'm not accounting for in this scenario. When we look at numbers, we have to be careful how we interpret those numbers because with an investment account, there's an advertised number, but then what you net out of it is less. And with whole life insurance, the number you see is actually what you get, but it also doesn't account for all these other benefits that you get. And I'll probably do a more comprehensive scenario where I place a value on each of these so we can make it even more of a fair comparison. But again, whole life insurance provides permanent death benefit protection. We don't get that in the investment scenario because we only have temporary death benefit protection from the term life policies. When that term expires after 30 years, we have no death benefit protection. This is permanent death benefit protection, which means it also accounts for legacy. We know what we're leaving to the children on a guaranteed tax-free basis. Cash value grows at a guaranteed interest rate plus dividends. There's no downside risk. There's risk and volatility with market-based accounts, not so in whole life insurance. There's long-term care protection. That death benefit in your whole life insurance policy can be used in the case of a chronic or terminal illness. There's creditor protection. Cash value in a whole life insurance policy can be creditor protected. It depends on your state how strong those protections are, but that's another benefit that is not included in your market-based investments. To account for that, maybe we'd have to account for the cost of buying a liability insurance policy equal to the value of your investments. No market risk or volatility, guaranteed policy loans. So you can borrow against the value of your policy on a guaranteed basis with no repayment terms without interrupting the interest and dividends you're earning in the policy. That's not something you can do with an investment account. You can, in theory, borrow against an investment account, but the terms are going to be set by somebody else. They're going to be real repayment terms. You're going to have to qualify, and you're putting your whole portfolio at risk when you do that. Plus, you won't get the same loan to value. You can borrow against 95 or 100% of your cash value. No bank or third party lender is going to let you borrow against 100% of your investments. It might be 50% at best, and the terms will be pretty strict, and you're increasing the risk when you do that. Whole life optimizes all your other financial assets. This is another thing that's difficult to demonstrate. Whole life insurance by itself gives us some very unique benefits, but it becomes even more powerful when you consider how a whole life optimizes everything in our portfolio. So there's quite a few things we could talk about. One would be using whole life insurance as a volatility buffer. So you can have whole life insurance and investments. And because whole life insurance is guaranteed to go up every year, when you're drawing income from your retirement assets, you don't want to draw income when the market is down because then your portfolio will last a lot less longer. But if you have whole life insurance, you can pause withdrawals from your retirement account when the market is down and draw cash value from your life insurance policy instead for, let's say, 3 years until the market recovers. And then you can resume drawing from your market based account. And studies have shown that can increase the longevity of your portfolio by at least 10 years. And that's just one of the ways in which whole life insurance makes everything else about your financial life better. That's not going to be seen in the whole life insurance policy itself. And lastly, and probably most importantly, is the peace of mind that this gives you. The psychological benefit of whole life insurance is phenomenal. The bedrock foundational asset that it is means that you're going to do everything else better. It's easy to put a financial plan on paper, but can you execute on that financial plan? It's like putting a diet and exercise plan on paper. That's great, but can you execute on it? Whole life insurance increases your ability to execute on any financial plan with discipline because you have the protection, the security, and the peace of mind that whole life insurance gives you. So this is just to reiterate that A, there are a lot of benefits in whole life insurance that we're not accounting for in this exercise when we compare it to an investment. And B, it optimizes everything else about your financial portfolio, the benefits of whole life insurance, and not just the policy itself, but how it allows you to utilize all your other assets so much better. Let's look at the whole life insurance scenario. Here we're simply contributing $25,000 a year over 30 years to our whole life insurance policy. And we can see how the death benefit, cash value, and premiums grow over time. The gray is how much money you've paid into your whole life insurance policy, $25,000 a year over 29 years, actually, not 30. How your cash value grows is in orange, and how your death benefit grows is in blue. Over the course of 30 years, we pay $725,000 in premiums. That's in 29 years. We don't pay a premium in year 30. We end up with $1.7 million of cash value. In the investment scenario, we ended up with 1.4 million in total value. Here we have more without taking on any market risk or volatility. $1.7 million in cash value and a permanent $2.9 million death benefit. The death benefit actually drops a little bit. There's reasons behind that. I'm not going to get too deep into case design, but that's deliberate. After 30 years and paying these $25,000 in annual premiums in our whole life insurance policy, we have $1.7 million in cash value, which is more than what we had in the investment account of 1.4 million, and a $2.9 million death benefit. All of this is completely unaffected by market crashes. There's no dips in the cash value growth. The 2000 tech wreck, the 2008 financial crisis, the 2020 COVID crash did not affect this whole life insurance policy. So, getting back to what I said earlier about how this optimizes all your other assets, what you can do is when the market crashes, you can borrow against your whole life insurance policy and buy assets on the cheap. I'm not showing that here, but this is just another way you can coordinate your whole life insurance policy with your investments. Instead of just investing a certain amount every year, you can hold some back in your whole life insurance policy where you can wait when opportunity knocks, where you can buy assets on the cheap in the depths of a crisis and double your money in a year by buying safe or relatively safe blue chip stocks, blue chip assets. That's not shown here, but I want to keep emphasizing how whole life insurance can improve the performance in your other assets. But here, just whole life insurance designed properly with the right carrier is getting you more cash value than what you would have had by investing in the market over 30 years, not to mention a nearly $3 million permanent death benefit. Our net rate of return on our cash value in this scenario is 5.2%. In the market, our net rate of return was 4.4%, even though the headline number was nearly 10%, which you actually got after taxes and fees. The real rate of return, not the average rate of return, was 4.4%. Here, our rate of return is 5.2% because in that cash value, no taxes are going to be paid because cash value growth is not taxed, and the fees are already netted out. Whatever fees there are netted out, have already been paid to the life insurance company. And so you actually net a 5.2% return on your cash value when you consider you took on no market risk to get that. And that's a net rate of return. So you're not paying any taxes on it. That's a tax-free rate of return. Plus all the other benefits you get from whole life insurance. That's pretty impressive. And of course, one of those main benefits is the permanent death benefit. If we measure the rate of return on our death benefit, it's an 8.1% return because we have $2.9 million. And that is a permanent death benefit. It will continue to grow and it will be paid. So whole life carries no market risk. To summarize the comparison, investing in the S&P 500 in this example over 30 years, you invest $689,000. We're subtracting out the cost of term life insurance, and you end up with $1.4 million in the market net of taxes and fees over 30 years. If you put that same money into whole life insurance, that's $725,000 in premiums. We were able to put more in because we did not have the extra cost of term life insurance because whole life insurance obviously provides us with a death benefit. we end up with $1.7 million in cash value. That's all net of taxes and fees. We didn't take on any market risk to get there. And we have a $2.9 million death benefit. Over the last 30 years, we see this particular whole life insurance policy has outperformed the S&P 500 when we account for taxes and fees and the cost of term life insurance. And the rate of return net in the S&P 500 was actually 4.4%. The average return over that time was 9.67%. So that's what people think they're getting, but that's not what you're actually getting. That's just the headline advertised number. Your real return is going to be different from the average return. And then your net return after taxes and fees is different from that. And then, of course, if we're comparing it to whole life insurance, we also have to account for the cost of term, because if you don't have a whole life insurance policy, you're still going to need life insurance. And we're not accounting for any of the other benefits that whole life insurance is giving us that we don't get by investing in the S&P 500, such as the long-term care protection, the creditor protection, guaranteed access to policy loans, tax benefits, etc., not to mention the peace of mind. 1.4 million we've accumulated in the S&P 500 versus $1.7 million in whole life insurance. And of course, here after 30 years, we have no death benefit because that term policy has expired. So we have zero death benefit. Whereas here, we have a $2.9 million death benefit. That's really important because as we approach retirement, we don't need to worry about what we're going to leave for the children and the grandchildren. It's already taken care of. So it gives us a permission slip to spend the assets that we have more freely, knowing that death benefit will replenish those spending when we die, and our heirs will get a nice death benefit without paying taxes, and that's not taking on any market risk. So in this scenario, whole life insurance outperforms market investments. And another thing I'm going to get into, which I have in the past, but also not only that, when we look at the headline number, it's not showing us how much income we can get out of the policy. And what I'll show you in another subsequent scenario is how whole life insurance can generate more safe retirement income than money you have in a market account, even if the dollar figure is equal, because whole life insurance is a two-dimensional asset because of your ability to borrow against it without taking on debt and without interrupting the earnings in the policy.